This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. We've got, as you know, Q1 earnings already in play. Banks reported. We've got a bunch of aerospace plays coming up this week, but basically this is the big official kind of kickoff. 15% of the S&P 500 report this week alone. And here's where earnings are kind of sitting right now. Bullish in a nutshell, and I've written about this. Expecting about 12% year-over-year EPS growth and strongest expectation heading into an earnings season since 2021 post all of that QE. You've got consensus estimates pointing up. We've also talked about that. And very much focused on tech acceleration. So even though the general estimates are about 20% year-over-year EPS growth, for tech it's higher. So this is where we've got right now a basic fundamental push. The Harknets of the world, Bank of America, was on risk reversal saying he can see 7,600 on fundamentals alone based on earnings. So war aside, and also mid-year presidential election aside, basically the earnings backdrop is fundamentally driven by the bit dip, according to Bank of America, Morgan Stanley, Goldman Sachs, the usual suspects. All right, so we do have this increased, this is the funny thing, right? Despite all of the supply shock risk and higher elevated oil prices, nonetheless, we have a change in consensus for the S&P 500 of 5% since the start of the war in Iran. Yes, I know, right? It's like, anyway, we've got earnings basically being up and to the right, and why a lot of fundamentalists are saying that's why stocks are trading at all-time highs. And that lower multiple that we talked about last week, they're growing into their 330 forward price earnings multiple. And that's what's carrying the market. We've been here before. And basically, this is what it looks like on a cumulative basis. You can see the March to April capitulation lows on the tariff terrors, and then the resulting increase into the petering out in October, peak in many, many names. We retagged highs in December. That was expected. And then we rolled over underneath the surface. And then we had that quote unquote generational buying opportunity. Remember Goldman Sachs and the post that I did about flows over fundamentals, but also generational buying opportunity in my client post a few weeks back. Well, sure enough, forward consensus is still rising, and that's what's very, very much driving a lot of the fundamental bent. We've got flows of short covering and quant price insensitive buyers. We've got institutions coming in here, but a lot of delta neutral chasing because of the gap and go. So that gap flip is about, 200 points behind. And that means there's some distance to make up before we can even reach parity in gamma flip. So in other words, we're like 6,900, the market's 7,100, basically 200-point difference. That's the reason why we could do a little bit of a grind here just in time. In other words, we correct in time, not price, before we potentially correct in price. But for right now, earnings season is usually kind of flat and sticky and helpful, if you will, to the fundamental narrative of supply and demand for the tech space. And what's really, really, really driving this, curiously enough, is Micron. So the handful of stocks, this thin concentration risk that we have of the Mag 7, well, there's one stock in particular that has contributed over half of the S&P EPS revision since the start of the war. So remember that 5% increase? More than half of that increase has been driven by Micron. Massive, massive, massive outperformance. Look at this 605% EPS growth. Obviously, SanDisk over here with 1,000. So you can see how this is really coming up with the top 10 contributors of the median S&P stock is just way to heck down here at 9. The top 10 contributors are 135%. So this is helping lift the markets. And again, I keep using the fundamental word because the start of this rally was flows over fundamentals. And now you've got the fundamentalists coming out and saying, hey, we have a generational shift here due to AI, and Micron's earnings and the rest are proving out that thesis. must-own stock, et cetera, et cetera. Micron has become number one in many, many portfolios. It used to be Apple, then it was NVIDIA, now it's Micron. So that's kind of the fundamental story behind, and we'll get to obviously test all of this out as time goes on. But I wanted to just highlight another kind of crash up read, which I think is pretty important, and that is, all right, so you've heard the midterm playbook, hopefully, before, which is any president that comes into a midterm year typically has a 20%, this is a midterm year, by the way, because we have midterms in November, comes into a 20% drawdown thereabouts. And then in every single example from 1974 onward, the statistics are a gain follows on average about 33% 1 year later. Yes, that is what the market prices in on a statistical basis. I'm just letting you know. And this is also fed into those algos as far as price is a history of buyers and sellers. Well, historically, in a midterm year, in pretty much all of the years, you have a situation where the average drawdown is 19-20%, and then the average rally 1 year gain, I should say, from the bottom is 33%. So when you have Wilson coming out and saying he sees 7,600, that's one of the reasons. That's one of the contributing reasons as well. So you've got a 19% drawdown we really haven't had yet. So this is one of the things I wanted to highlight. I put this little red arrow. We have followed, in some cases, a really nice fractal of this particular historical playbook, the midterm year playbook. And as you can see, we had this very sharp reflexive bounce on fake headline. Of course, the Strait of Hormuz is not open. It probably never was, despite Trump's rally call, but it did trigger massive covering. We know that. Mechanical buying, flows, et cetera, and then everyone jumped in. But the point is, now we have gone from oversold to overbought. Petering out would not be surprising. Today is the 20th. You can see this fractal from Nautilus, April 17th. Well, this is the 18 to 20% drawdown that has been historically in play before a bottom. And you know how September is October, the most volatile months, before a bottom, and a 33% advance 1 year later. So I'm just recording the news. I'm letting you know that's the midterm playbook. So what are some of the levels we got to watch carefully as it relates to how low can we go before it gets supported kind of stuff? Well, take a look at SPY. I'll do SPX. Right now we're at 71.26. Here was that overshot. If we got above, I said if we get above that 69.45, that's important because we've been rejected all year, December, January, February, right? And then we rolled over, hit that low, came right back up to 65.08, boom, ricochet rabbit. If we got above 69.45, I said, well, that's my next line in the sand would be the 71.06. We closed above it. Here's a daily kind of view of that same kind of teal view. We're right above it, sitting above it. Yes, we can come and do a fake breakout, fast failure, and that's what we're going to be looking for. So if we come back inside, just generally 7,100, then we need to push into that kind of 6,700, 6,650, 100. You can see it. Now here's just, let's keep it simple. 6,700 is obviously a little bit far from right now, but that's the 200 day. So not really. You can overshoot the 200, ricochet back up. We have the big ceasefire headline, and now we're way above the 200 day. We could come back to it. So this is where we would have to watch for any potential collapse. In other words, it doesn't hold. It just doesn't hold. But this is kind of the clean level. It gets back inside 7,100. We can go test that 69.45, 68.45, and then 6,700. So that's what we're going to be looking for. And right below it is the 200 day. And how we deal there is whether we get a trend reversal or whether we get resumption of a bounce higher from there. So that's what we'll be looking for. Again, this is just a nice little review of where we're at. 15% of S&P companies reporting, very robust earnings expected, big increase in consensus because in large part Micron, et cetera. This V-shaped has gone boom right into a geometric mean, but at the same time, we haven't even started the 18 to 20% customary pullback from April into September in a typical 4-year presidential cycle. So that's just a quick overview this morning. And remember, this market has gone from oversold to overbought in a New York minute. So right now, lots and lots of grind in time would not surprise.
Join club to trade with Samantha. Scan this QR code or click the link in the description.